Hi, I'm Owen from Rask Australia. Thanks for tuning into the Rask Network. Before we get into today's show, there are a few things we have to go over. Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you'd get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program. Niki, thanks for taking some time to join me on the show.
Thank you for having me.
We're going to talk about venture. We're going to talk about your journey to this world and then to the pinnacle of this world and how you think about the future, what's happened in the past and even the present today and where you are. But I thought maybe we'll start with some icebreaker questions. And these are just a bit of fun, mate. So no need to overthink them. Kind of the first thing that comes to mind is, what's the one investment you got totally wrong?
Well, there was a company in 2014 around Dogecoin. And this was, Dogecoin was actually invented by an Australian. And so we'd got to meet the founder, and then another Australian over in the US had formed a company called Doge Tipbot. This allowed people on predominantly Reddit, if you like to comment or you like to post, you could tip someone, 10 Dogecoin, which back then was like fractions upon fractions of a cent. It was sort of laughably nothing. It was an interesting community that had sprung up, and interesting sort of behaviors around that, when there was just no friction to acknowledging someone with 5 cents, and the fun that came out of that and the social status that came out of that was like very fascinating. The company did not work out in the end. And I think we were the only professional investor in the world to invest in a Dogecoin company. And then many years later, Elon Musk took a shining to Dogecoin. And I think if we actually had invested just in Dogecoin at that particular point in time, it would have worked out, 1,000 times our initial investment, but it was not to be.
Well, sometimes you don't know if you're early or you're wrong. So maybe we'll just take that as early.
Or both.
Or both, yeah. Okay, so the next one's a bit of fun, and this one relates not so much to investing, but it's just yourself generally. If you could have one skill that you could acquire almost instantly, what would it be?
I've got a taste for listening to podcasts or audiobooks on 2x speed. And I just, if you could listen to it on 20x speed or 100x speed, just imagine, like, reading is my favorite thing in life. And if I could read or listen at 100x speed, I think that would be a superpower for knowledge.
Wow. I'm sure someone listening to this right now will be going away and, and doing just
adjusting their podcast up to 100x.
That's it. Okay, final one. What's one thing you'll teach your children, maybe if it's about investing or even if it's about life, however you want to take this, that you think few other people would be doing?
I'm a very chaos is okay, or pain is a good thing. Sort of people, I think, try to eliminate pain from their lives. Like zero amount of pain is the right amount of pain, versus obviously too much pain is too much and is unhealthy. But there is some level of pain which is actually a healthy amount that spurs people on to do great things, to progress. And so I think not to be kind of 100% afraid of pain, because it does tend to be a clue that you're doing some new things or interesting things, or learning in an uncomfortable way. So pain is not all bad.
It's interesting that you say that, because one of the things that I try and impress upon nearly everyone that I meet is risk is okay. When we think about risk as a society, we tend to think about how bad that is, but it actually can give rise to so many interesting things, which we're going to talk about, I'm sure, a few of those. Why don't we start there then with your journey? Was entrepreneurship, starting a business, was investing, any of these things, were they ingredients to you as an early child, I guess?
I loved computers and I loved technology. That was very in sort of my youth. The internet was just coming about, and a few years before the internet, there were bulletin board systems where you had a a modem that you connected to your landline telephone and dialed up someone's number who was hosting a bulletin board system where you could, kind of chat with each other and play computer games and yada, yada, yada. It was sort of like a very rough precursor to the internet. So I'd always loved computers, and I'd always loved technology and so on. So I had that love. The love of entrepreneurship and investing, I think, came a little bit later. Having said that, I did, as a kid, I had access to the internet very early on. This was before Netscape and when it was a text browser called Lynx. And I used to download NBA basketball box scores and reports, and kids at school would pay me $5 a month to follow a team. So if you're, the Lakers, I'd print out all the Laker game scores the day after. It wasn't on TV. It wasn't readily available in newspapers. And so I guess there was some entrepreneurial activity, but it wasn't until university that I really fell in love with it. And that was around the time of the original .com boom in 1999. And I remember these technology entrepreneurship magazines called Red Herring and The Industry Standard, and they used to be like 300 pages every month, and going down to the newsagent, buying them, and that's really, I think, where the imagination was set off.
I've actually got a follow-up question to this, because in previous podcasts and interviews, you mentioned that there are those unique set of experiences, that it's kind of the phrase that you use. And I'm keen to pull this apart for you. What do you think it was that, even if we just take that example, but maybe we can lead this into the next question, which is the things that you later co-founded, what unique set of circumstances in your environment made it okay to go and do things like that?
I would say I'd always been encouraged just to do things and to learn things, and as a kid, built sort of radio-controlled cars, raced, did a lot of sport, competition, team. There was always encouraged to do different things and to follow my instincts and to take initiative and so on. So I think that's required in terms of possibility. I'm an ultra competitive person, and I will do something obsessively to win at whatever it might be. Computer games, again, probably is the big example in the youth. And so I think it was just always natural for me to go and try things and to do things, and business felt no differently to that.
I find that there's something interesting that happens with entrepreneurs, and you'd have a better window into this world than I do, of course, which is where sometimes businesses are not born out of maybe what we would associate with quote unquote healthy habits or, I guess, views of the world. So anxieties and these types of things that bubble up internally, and we maybe not even realizing, and these things feed on that kind of entrepreneurial mindset, if that makes sense. And there's something I give a lot of thought to is, where does it come from? If we were psychologists unpacking this, like, where would that come from? And maybe not so much with you, but just in general, do you see that playing out? And do you often ponder this question?
Yeah, I think people who are obsessive and competitive and those traits taken to the extreme can cause the undoing of someone. Ultimately, they can also cause the success of someone, and even physiologically, a high amount of achievers have autism, and so there's something around traits that can be both extremely positive from a entrepreneurship creation point of view, and obviously negative taken to the extreme.
I often find, like, I think it was Steve Jobs who has the quote or the speech where he talks about how, I can't remember if he uses the phrase crazy ones, but I can't remember exactly, so I don't want to take anything away from him with it, but basically says that in order to be exceptional, you have to do something that is not ordinary. And I think that's something which stands out to me, is often I get questions around, does it take something like that to produce something that is so unique? I guess the question therefore is, do you have to be obsessive to create something that people remember as that kind of 10 to 1.
Maybe all of the great founders I've had the fortune to see up close have a sort of complicated personality. Even if you think of entrepreneurship as a form of artistry, and any kind of singer or Van Gogh as an artist, or a lot of musicians ultimately committed suicide, and so there is a dark side or a complicated side to these very unique individuals that go on to greatness. And I don't think you need that. I think everything is also not binary. It's not like you have something, you don't have something. You have a degree of something, or it's sort of present on a spectrum. And then I think for success, you also require a complement of people. You need a balance of folks, and certainly you do need the craziness, you do need the uniqueness and the strange to something, but you also need the balance and complementary personalities around that kind of visionary type person.
You, if I'm not mistaken, you co-founded 2 businesses. I'm not sure if this was in uni or out of uni. Can you talk us through those businesses and some of the lessons learned?
Well, the first one was only notable for who it was founded with, which was Mike Cannon-Brookes of Atlassian. He and I went to university together and were roommates together, and so on. And he had also sort of caught the bug of technology entrepreneurship. He was building websites when he was 15 years old. He was one of the ones that I used to swap the red herring industry standard magazines with, and so on. So we decided as first year uni students to start a company. The company was called the Bookmark Box. This was back in 1998. It allowed people to manage and share their bookmarks. And back then that was important because laptops were too big and too heavy and too expensive, and people had different computers depending on whether they were at work or school or at home. And so this allowed you to sort of manage and share your bookmarks across all those computers, and then took a different turn with the product in that it was a sort of way in which to attack web spam. Web spam was a real problem back then. This was pre-Google, where people were sort of just writing random keywords in their pages, and they would hope that they would rank highly for those. But we had this sort of about 50,000 users, 8 million bookmarks, and kind of a clue as to what were the trusted pages on the web, and to elevate those bookmarked pages higher than others. And just as we were sort of taking the product in that direction, we ended up selling the company to another firm in New York called Blink.com. It had raised lots and lots of money before it launched. There were other companies that raised lots and lots of money, and we both sort of saw the writing on the wall, or felt the imposter syndrome acutely, and we were the knife in a gunfight. And so we decided to run a process where to sell the company. Again, these are all highfalutin terms for what was a very small kind of financial outcome, but it was a beautiful kind of 2 years of education. It was just 100 kilometers an hour, learning every single second along the way. And I often say that the Bookmark Box was my university degree. I met so many awesome people at university, but the actual content, I felt I learned 10 times more via the Bookmark Box than the university degree itself. Then I moved to New York shortly thereafter. This was post-university and completing university. Started another company called Home Thinking. It was a real estate website that crawled all of the home transaction data to know that a particular agent sold the most homes for the best prices in a particular neighborhood. And so you as a homeowner could enter in where your house was. You could get back a list of people that had this sort of quantifiable resume of all the homes they sold, for what prices, how long it took them, as well as sort of consumer reviews left by homeowners as well. So as a kind of quantifiable way to make a decision. That business succeeded for a little while there. It rode the kind of organic search wave of Google. This was in the 2005 period, but ultimately kind of failed in its quest to build a great business. it was wholly focused on just that who's the best real estate agent decision. Whereas the sort of traffic magnets were very much the real estate listing sites themselves. So sites like Zillow and Trulia in the US, where they succeeded with that consumer audience that they then tacked on this additional function of finding an agent using this way. And so the business ultimately did fail. I think the lessons I learned from that were I was a single founder, and so to not have a co-founder, I don't think I'd ever do that again. I think that emotional kind of balance that is the feature of what you get when you do a company with another person, another founder, is I would never not do that again. And then ultimately the sort of customer test of I didn't feel empathy or in love with sort of the customer's problems. Ultimately, I loved technology. I loved making decisions in a data-driven way, and I loved search, but I didn't love real estate agents, and I didn't love sort of the businesses that they were building. And so, one test is if you see your customers in the street, do you kind of run into a laneway or do you run up towards them? And that was not true for home thinking, but has absolutely been true with Startmate and now Blackbird.
We talk about in technology, we talk about being agile, basically, which is for an investor, it's like the counterpoint, basically, like what could go wrong. And we often say that when you're agile, you want to fail fast. Do you think the velocity at which you've, say, air quotes, failed, I'll say failed, but, do you think the velocity at which those things came and went was positive for you?
I think home thinking was too long. I do. The ultimate sadness is when something doesn't fail or doesn't succeed. There's a kind of third state in between where it kind of goes along, but is not going to be, the outcome that people wanted originally. It's not, a great business, and so it's sort of, but failing that, there's no, it has revenue, it has customers, it might even be growing, but it wasn't what was imagined when the company began. And so I think home thinking, which was about sort of 5 years, that probably should have been a few years shorter, had it all perfectly worked out. Having said that, the Bookmark Box was, I think, 18 months, so that was probably too short to really know could we make it or not in that original vision. And obviously 1999 was one of the craziest times in the world of internet technology. So that was the predominant variable there, rather than a micro sort of choice that we made.
Because if people look at you now, they'd say, well, how successful has he been? It's wonderful. And those experiences shaped who you are today. The next part of your journey is the really interesting part from what you've built and what have you have allowed other people to build, especially. So I heard you say that you were interested in finding other businesses to invest in, and at a time you were writing maybe a couple of checks a year for $25,000 to help entrepreneurs get started, basically. Can you describe the problem that you identified with that and the journey, with Startmate and then Blackbird?
So I'd moved back from New York to Sydney. And I think from both New York, but also I was in San Francisco quite often. And as I mentioned, in the case of home thinking, you'd got to know other folks like the founders of Zillow and Trulia and Yelp, which started around the same time as home thinking, and had got to know a set of companies and a set of founders that when I moved back to Australia, what struck me was the people I was meeting here were just as good as the people, the best of the best that I was meeting, had met in the US. And so there was a sense of, all of this great, this magic happening, but no one really paying attention. So that was a prompt for the desire to start angel investing. Angel investing in the form of 25K. So not fortunate, but not you're not sort of a kingmaker in any sense if you're writing $25,000 checks into seed round companies. And the people I was meeting at the time, people would raise like a $300,000 round or a $500,000 seed round, and $25,000 wasn't enough to bring the round together. If I was, saying yes at the front of the process, I'd introduced some people I'd met to other folks that I knew to help that along. But it was, I would say, there just weren't that many people interested in angel investing in Australia in 2010 at the time. So there was a sense of having to create a market or to create something that wasn't there, and that led to Startmate. The other thing that was attractive personally was it would allow me to do investing at a greater frequency, spread across a greater portfolio of investments, but also speed up the learning. Normally, as an investor, as a VC, you might invest in 2 companies per year at a sort of set pace, versus in Startmate, we could invest in 5 companies, 10 companies per batch, do the batches twice a year, see hundreds of companies in each of those application processes, and so there was a rate of learning advantage there. And then also, what I'd noticed is in Silicon Valley, the magic of Silicon Valley is when someone creates a successful technology company, they help and invest in the next generation, and that wasn't true in Australia in 2010. People who had succeeded tended to sort of stick to their own circles, or they might have succeeded and retired and bought real estate in Byron Bay, but they hadn't really shown an interest in investing in the next generation of technology companies. And so the other important element of Startmate in the beginning was this community of founders who were interested in investing and helping the next generation. As again, the batch unit enabled them to sort of efficiently help the next generation in this format of investment. So I would say I moved back, I started looking around. It was kind of slowly happening, but it wasn't very exciting. And then by creating Startmate, we could bring all of these elements together. I could personally learn much more quickly. It was a better way to financially invest across a number of startups instead of a single startup. And then that was the beginning of Startmate.
It's fascinating because as I thought about this over the weekend before recording, I thought about that community which you foster. It just creates connections, right? And it's founders helping founders, as well as the, the oversight or support of the VCs. When you think about that now, why would a founder that's listening to this, why would they go to Startmate now? Like, is it, from their perspective, is there some type of tangible benefit in engaging with you?
Yes, absolutely. The word I love is accelerator. It's not to say someone who's listening can do something or not do something without Startmate. It's, can they do something much more quickly and make much more progress in a set amount of time? And so I think accelerator does capture it beautifully. Every time you come up to a fork in the road to talk to someone who has just made that decision recently, that is the ultimate in high quality advice, to be able to tap into a network, whether it is for hiring, whether it is for winning a customer, whether it is for raising money, that sort of golden network that people, again, feel deep affinity for the Startmate brand because they themselves were in that very same position a few years ago. And it really is quite magical when you see someone make that request and 10 different people sort of dive in to help and to that kind of magic circle of life where those who did benefit are helping those next generation.
You said before that there would be hundreds of applications for these, and does it run twice a year?
Currently, yes.
Yeah. How does it go from the 300 down to the cohorts?
So all of the mentors, and again, the other important element was that the mentors invested in the fund, and so the mentors make the decision as to who eventually makes it into the batch of Startmate. So there's hundreds of companies apply. Different subsets of mentors view all of the applications, and then as you get down to another level, then everyone reviews it, and then there's an interview day with the final, call it 30 companies, and then the batch sizes at the moment are anywhere between sort of 10 and 20 companies, and so the mentors are involved all the way through that. And I would say both in Startmate's case and also Blackbird's case, it's really that community at the heart, rather than sort of the expert on top of the mountain saying that they know everything and them being the oracle. It's more sort of the value of both Startmate and Blackbird is a community of other founders, and Blackbird and Startmate acting as this network switch to those founders at those moments in time.
Yeah, it's fantastic. I imagine that also makes what you do easier because you can rely on this hive mind of expertise. It's current, that's forward thinking, and you can leverage that as well. Can you talk us through then the origin story of Blackbird and maybe how it came to be versus where it is today?
Yes. So as I mentioned, the initial prompt of Startmate was so that I could begin angel investing. It was personally driven from that side of things. And then what was very clear through the first 2 years of Startmate was that this is actually what I should be doing in life. So when I began Startmate, it was only ever a part-time thing. It was 2 days a week for a couple months of the year. And as I said, personally looking to start angel investing. I'd moved back to Australia. I was thinking, should I do another company? And I had sort of was playing around with a few ideas around conversion rate optimization software, A/B testing software, and a marketplace around that. But just instantly from Startmate, it was just very clear that this was actually the biggest startup opportunity. As I mentioned, there were all of these world-class people, no one paying attention to them. There were already these very successful companies, Atlassian, WiseTech, Campaign Monitor, Redbubble, Aconex, et cetera, that had already succeeded, and no real investors from Australia paying attention to them. And majority of them did have US Silicon Valley venture capital, but much later stages. They might bootstrap for 8 years and then raise a round from those Silicon Valley venture firms. So I think it was just very clear that this was a huge opportunity, and this personally was very clear that this is what I love doing in life. The people I met through the Startmate community, whether it was on the startup side or the mentor side, it was just unlike anything I'd ever had in a work context. And so that kind of visceral success and visceral happiness from Startmate led to let me make this my full-time career. This is the most impactful thing that I can do. And so in 2012, teamed up with Rick Baker and Bill Barty to form Blackbird. Through the first couple of years of Startmate, it was also very clear that you could create these global companies from Australia. And so what I meant is that even though the team and the company was in Australia, all of the customers were all over the world. It didn't matter that they didn't know or care that you're in Australia, but they just they bought the software because it solved their problem, and they didn't need to speak to a salesperson. They signed up with a credit card or bought it through the App Store or what have you. And that particular type of business being built from Australia, that was the original hypothesis for Blackbird. Again, we'd seen the power or the magic of founders helping other founders. And so the idea of Blackbird was we'd raise a fund, and that fund would predominantly come from the founders of those successful companies, putting in their own personal money, but also their own time to help out the next generation. And so in 2012, formed Blackbird. Took us 2 years end to end to raise all of our first fund. We did a kind of first close 1 year in to the journey and ended up raising $29 million. It was so hard. We met more than 500 people. There was hardly any venture capital left in the system. There'd been kind of 2 waves of venture attempted in Australia, but nothing had really succeeded to any great extent. And so when it was mentioned that we were raising an Australian venture capital fund, nearly every single rational person said, what are you doing? Why would you want to do that? That sounds like a paradox of no, an Australian venture capital fund is not going to work. And so, but of course, it being so hard and it being very strange was exactly the best time to be raising an Australian venture capital fund. And the first fund was fortunate enough to invest in the first rounds of Canva and Safety Culture and Zoox and Culture Amp and Propeller, and the list goes on. It was really a very special time to be an investor in software and technology companies back in 2012.
Was Startmate, for deal flow, was Startmate a key contributor to that first fund?
Yes. So we the reason Blackbird was separate to Startmate was set up for a particular audience of founders at a particular stage in their journey, like right at the beginning, and the sort of fresh inception. And so we always knew that Startmate would be a contributor to the Blackbird deal flow, but it would never be 100%. It turned out Startmate was 20% of the companies of that first fund. So about 1 in 5 investments came from Startmate originally, but obviously 4 out of 5 did not come from Startmate. The opportunity for Blackbird was sort of wider than that original Startmate community.
How did you... I'm just curious about that first fund, because this is when it was, like you said, it was the ideal time in hindsight. But how did you find many of those companies then? Did your network, was there anything that you did differently? Like, were these hiding in plain sight?
They literally were hiding in plain sight, and we were literally a cup of water in the desert. It was like, finally someone is interested in investing in this kind of company. And even for the people who were those investors in the first fund, it was finally someone is doing Blackbird, because oftentimes they had built their own companies that were similar to this global software company, and they saw up close what beautiful businesses they can be, and they saw other founders asking them out for coffee, and that they saw the opportunity kind of firsthand from building their own companies. So I would say, from a deal flow point of view, if you have money and you want to invest it in a particular kind of company that had been shunned and ignored in the past, there was no sales and marketing. It was instant sort of deal flow. But also from those networks, obviously the context you get from either an LP or another founder who knows that person, and that's all valuable. And the deal flow from those folks is extremely prized. But I think to keep it very simple, we had a fund that wanted to invest in companies, and there were lots of those companies who had not been loved by any other kind of investor before.
People that know of Blackbird will know of this idea of investing in generational companies. So maybe just to frame out the next part, which is we're going to talk about your investment process and how you think about the philosophy behind the fund and what you do. Can you just explain to us what exactly you mean by a generational company?
So in the world, a small amount of companies will account for the majority of value. And if you look at in the US, the many of the top 10 companies are technology companies. In China, the top 2 companies are technology companies. And technology in particular has this characteristic of allowing companies to compound for a very long period of time. Google at hundreds of billions of dollars of revenue, still growing, not this year, but last year grew north of 20%, which is just record-setting, beautiful businesses. And so in venture capital, there's a phenomenon called the power law, which is like one company tends to account for the majority of value, which means that one company is worth more than every other company. And In Australia, in the first decade of this century, Atlassian accounted for the majority of all value created by all technology companies. In the second decade, I'd argue that Canva has accounted for the majority of value of every single technology company ever created in the last decade. So you have this phenomenon that is very kind of strange, but that is how the business absolutely works. And so the idea of Blackbird is to find those generational companies right at the beginning and then to invest in them at every single stage of their life. And so with Canva, we first invested $250,000 at the very first seed round. We've invested more than $270 million just into Canva. And so the business of Blackbird is about relationships and those generational companies, which sounds a bit general and squishy, but the venture capital industry is not structured like that. The venture capital industry is sort of divided up into the round of capital. I'm a seed fund that invests in seed rounds, and I sort of stick to that particular stage, which didn't ever make sense to us. And some funds specialize just in investing in growth stage companies and just invest in that particular round. And so that's how the industry is structured. We made Blackbird about the company and about forming a partnership with them very early on in their lives. Hopefully Blackbird is the investor in the first round. But that relationship ultimately leading to the privilege for Blackbird to keep investing in the company. I don't think we ever deluded ourselves that Blackbird could outcompete Accel and Sequoia in a particular round without particular history. But if Blackbird invests in the very first round and builds a great relationship with that company, that relationship can outcompete the brand of Accel and Sequoia when the company is clearly a success story and clearly every single person in the world would love to invest in that company. So the strategy of Blackbird is to start at the very beginning and then to invest in every single round of capital.
Have you read the book Gorilla Game?
I have heard of it. I have not read it. No, sorry.
Yeah, no, that's okay. So the basic premise, if I could simplify it, so apologies to the authors if they're listening, but the basic premise, it was written in 97, and is that you identify the gorillas that take the share, as you said, power laws, but you can identify them early. And the problem is a lot of value investors struggle with this conceptually because they tend to think as each individual investment is a value investment, where at least in this book, the principle is that you take a broad approach to begin with, and then as the gorillas are identified, you move your chips across the table. And this is the idea that most of that value is captured, and people tend to underestimate how much value is captured, because what happens is as the gorillas emerge, the competitive advantage period, i.e. the timeline for them to dominate, expands, but it also expands in another direction in terms of value creation and value capture. So you have an exponential amount of value creation over a longer period of time. And so a lot of people think like, oh, you know, in public markets, they think, oh, stock's gone up 100%, therefore it's overvalued. But no, maybe the value creation that's going on is exponential. And so I guess that leads to the next question. And this relates to, I think, where you're going with that point is that by being there on day one, I think you've got a thing on the website which says day one, I think it's like day 1,000 or day 10,000 or something crazy like this. Do you think that approach, like that venture style approach, is we get as many of these smaller deals as we can across the line to prove that we are here and we are valid, and then the founders look more favorably upon us? Is that basically the idea?
I would. So it's very similar philosophy to what you've described. But I would say just in the beginning, having a humble enough approach to know this is something worth trying, this is something worth exploring, and not overthinking it in terms of wanting to know. You want to know every piece of information at the beginning, but you don't have that until you begin exploring with the founder and with the company whether it is a decent market, whether it is a problem people care about. And so I think at the beginning, it's giving interesting people with interesting ideas the money to go and explore those frontiers of the market, and knowing that nearly every single time you'll be wrong. Again, you have to sort of train your psychology such that, you know, when you lose everything, it is embarrassing. It is humbling, and it is kind of just gravity at work. But it's important to explore all of these different markets and to see if new things can be done, because out of it does come 1 out of 10 or 1 out of 20 times something that's truly, truly special. And so seed investing, the capital does almost like chemically react with an idea and make something possible that wouldn't be possible, versus at the end of the public market spectrum, 99.9% of every stock sale is a secondary. It's someone else owning the company, selling the share of that company to the new investor, and there's no change in the business in terms of the capital going to the business. And so at the early stages, it's completely opposite. The business sort of has nothing, and the cash absolutely changes the probability of that. So at the beginning, I think you're going on an exploration, and then as it becomes clear whether something is a very good business or a very good market, you're investing further capital over time. And so I think at the beginning, you have to again just have that sort of belief or that ambition, and be open to any different kind of direction, and not overthink it and not think how it might not work, but to think if it did work, would it be very, very important.
Yeah, there's this analogy that people have, which is that investing ahead of the curve is that it's about like connecting the dots. But then there's I'll bring Jobs up again, who talks about it's not like that's only in hindsight. You don't get the number, it's not as easy to just draw it from 1, 2, 3 all the way and it becomes a picture. But there's this idea of like Mosaic Theory, and the quicker you can put the mosaic together, the quicker you will reveal what it is that you're investing in. And most people want to wait until they know for certain, oh, this is a picture of an elephant, or this is a picture of a tree or something like that. We want to know what it is before we invest. And so people are always pushing to that frontier of how can I try and figure out what this thing is earlier on. But it seems like what you're saying is this thing could be a picture of an elephant, but it could be very much a snake or something like this. Like it reveals itself in time. And I think this is particularly important because you're investing most of the time, it seems, correct me if I'm wrong, pre-revenue. So you are willing to go to that edge and say, what is this idea? Then how can you use that idea and the initial bit of capital that we give you to then figure out what that picture is and where it should be going in time? Is that a general, I guess?
Yeah, and the other overlay I would add to that is the clarity of the picture you get as an existing investor is 1,000 times better than the clarity you get as a non-investor, or if you're just seeing the company during this sort of honeymoon period of fundraising, or you're just following from afar from media articles about the company. There is nothing greater than just the clarity of the information you get as to how the founders run the company, who do they hire, how hard is it to sell to a customer, or how easy is it? Do they complain about the price? Do they not complain about the price? The sort of good, bad, and the ugly of the company versus just the highlights you get at that kind of fundraising period. So I think that total picture of it, like seeing if it's an elephant, you see that with a lot more clarity as an existing investor. And also, I think just building that relationship, you're often afforded and you're preferred. Fundraising is like a big process. It is incredibly friction filled. On the other side of it, it is healthy to have a group of investors. Blackbird is never the only investor in a company that we're an investor in, but you kind of beyond a handful of supportive and helpful investors, you don't need 500, and so there's maybe 3 to 5 investors that play that role with every company, but the company itself would actually prefer to be, if they have a supportive investor base, to go through that fundraising and pricing. Obviously, they can say whether that is a good price or a bad price and test it externally if they do think it's not a fair price. But ultimately, that there is, with a relationship, a lot less friction to them raising that capital.
I think I read that online, maybe being an AFR article, about how terms and term sheets and those types of things skewed towards friendly for the founders. But I guess one of the questions is like, what are some of the characteristics? And I know that there's a full thing on the Blackbird website about the process you follow, about how you think about things from different criteria. It's really interesting. So I'll put links to that. But how do you think about the people? Because the people are paramount when a company is pre-revenue. How do you think about identifying the right people with the ideas to carry that idea forward?
I'd also say that Blackbird is open to a wide variety of people, and that's been I think part of our success is investing in people that look kind of unqualified or look a bit too raw or look a bit too unpolished. And I think even from the beginning of our journey, it was always very clear that the ultra successful cases, like people would say someone's a repeat founder as a compliment, and in some ways it is. But if you look at all of the ultra successful companies, the $1 trillion companies, they were started usually by first-time founders, usually by people that were really unqualified. They just finished university or they hadn't finished university in the case of Microsoft and Facebook. And so we were certainly open to people with no business experience being founder CEOs. And that in the beginning, I think stood us apart. I think people now are very open to investing in technical people with no business experience, but at the beginning that was a bit more unique. I would say you look at can the person the two shits for want of a better term, do they give a shit and can they get shit done? So do they give a shit? It's that connection between the person and the idea. What in their life has led up to that point of founding the company that has driven them to do so. Lou Kinnear was a workplace safety inspector before founding Safety Culture. Mel from Canva had taught graphic design at university and then had formed a high school yearbooks business before founding Canva. And so that connection to the problem. And then, as you know, in life, there are a lot of smart people, but there are not a lot of smart people that go and do things. They talk about things rather than doing things. And so just these often, it could be just a couple of months of data. It could be just very little things. But if you see someone spiking on a kind of bias to action, or they act really quickly, or they just the raw output, or even just the rate of learning. So someone who's completely unqualified, but you can just see that how they soak up knowledge, how they act upon it, that rate of learning, that vertical learning curve, that's something to pay particular attention to, because if you do that for a long period of time, you end up as the best CEO in the world, and people look up to those sort of cases after they've succeeded. But you get the chance to invest in them, when they're starting from zero. And so it's that rate of learning, that rate of improvement, that rate of progress. Any kind of spikes or any sort of glimmers of hope amongst what they've done in the last couple of months. That you should pay very close attention to that as well.
Yeah, I was chatting to a founder or co-founder, Nick Nicolaides from Perla, before coming in today. And he was saying that one of the things that he finds really interesting about you is kind of that initial, that genesis, like that the spark that goes off for these, you get these people together in this, in ancient times we call them a tribe, but now we call them companies. And then they have the idea, they execute on something, but then something else comes of that. It may not be the initial, thought, but something comes of that data, whether it's like community-based data, whether it's A/B testing or something they figure out really early. So is that kind of is that something that you see is very common? It's kind of like embedded optionality?
Well, I'd say it's part of the process, and I always like to describe ambition as the reaction to success. And so people might start off, very modestly with their vision, but if it does start to go right in whatever little way that you mentioned, what's their reaction to that? Do they sort of say, "Oh, that's nice that happened," and don't change anything, or do they spot it and they double down on it, and they think, oh, okay, how can we apply that to everything that we do in marketing or sales or whatever it might be? And so this sort of re-raising of the ambition at these different points in time, trying to spot little things that work and make them work in a bigger way. That to me is ambition, and those lessons of the business, and then sort of thinking and reflecting upon them, and then crafting a new and bigger vision because of those lessons. That's the ambition flywheel. And so I think absolutely that's part and parcel of every story. And I would say part and parcel of someone being ambitious is that, paying attention to successful things that happen.
Have you got any examples of that happening? Like, to give people, I guess, a visceral, or just like a thought in their mind of a name or a brand that might have done that, even if it's not something you've invested in?
I would say there's always going to be one question that's interesting to me in a company is what is their unique take on customer acquisition. Usually a company has some strange thing about how they acquire customers. So normally a company will come in and go, we're raising money, we've just spent no money on marketing and sales, so we're going to spend some money on marketing sales, and we're going to do headline Facebook ads, SEO, blah, 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 all at a headline level. The interesting companies from a growth standpoint tend to have this sort of insight at a ground level that's always quite interesting and unique. I remember in the case of Atlassian, actually before Jira, Atlassian was involved in a lot of the open source community. And so one of the first things that they did when they released Jira was to make it free for open source projects. So if you're an Apache whatever project, and they used Jira to manage all of the bugs that people were reporting in the Apache web server or whatever project that they might have given away the software. And then so those commercial people who were using Apache's web server would go, Jira was quite nice to log all of these issues and track the progress and the resolution of them. Why don't I use Jira in my own company? And then that's when they pay whatever amount of money, $800 to Atlassian at the time, to use Jira privately in their own company. So that idea of give it away free to public kind of flagship customers or case studies, in knowing that all of the people that interact with those public flagship case studies will need it privately for their own business. And so, like, when someone describes customer acquisition in that sense, I get very interested. And then obviously, once they discover it works in one case, then they're reacting and saying, okay, how can I do this for all of the open source projects, or all of the ways in which someone might be using the product in a public setting?
I think a lot of entrepreneurs nudge up against that issue of acquisition, right? Like, we all have great ideas, but then we've got this great product, and I find this with engineers a lot, we've got this great product, but why aren't people using it? Like, this is what it does, this, and this. And it's interesting to hear you say that with the Jira example, because we know that one. Like, it was some people that are in the industry would know that one and how unique it was. And it's also refreshing to hear that you can still do that, right? In a world where it's basically pay to play everywhere you go on the internet, Google, Facebook ads, whatever, like you said, to be able to be innovative in that way is very unique. And I've been inside a startup basically my whole life, not just with this business, but I've seen that customer acquisition, and sometimes it's frowned upon. Like, sometimes it's seen as, like, I don't know, scrimpy, or like you're the one that's, boots on the ground, you're pushing that line of what is normally acceptable, whether it's taboo or something in the industry, and people just get it done. They push that up against that boundary, and then a lot of people that maybe have a superior product in terms of features, they just don't get it because they're not prepared to go to that level. I don't know if you've ever come across that kind of idea of. Well,
it's also, I think, it's a system, or it's an organism where even if someone, just say at two opposite ends of the spectrum, you have the, nobody marketing person, and you have the highly technical engineer person, and the highly technical engineer person starts off with a better technical product, but the marketing person starts off with a technically inferior product. But if they grow and they work out this scalable channel of acquisition, then they use all of that extra revenue to hire engineers to hire, to reform the product roadmap, to get all of that customer, not only customer revenue, but customer learning of all of the feature requests, how they use the product, what they want in the future, what's the exact problem that they're solving in detail. And there's almost like a flywheel there where because you're successful in growth means that you are successful in the best information, the best, you can build a way bigger and better technical team and product. And there's like so even though the starting points might be, I had a better technical product, they don't end up as a better technical product just because of this all-encompassing kind of network effect of revenue and information and team that ultimately easily pulls away from the person who started out better technically.
Do you think that many of these companies can reach that point, like just before that point where, were they using a lot of no-code tools or low-code tools?
Look, 1,000 ways to be successful, I would again try to pass it through the test of is it a unique customer acquisition strategy? Not unique from a pure you're the only one, but like you're on the fringes and no one else, you haven't heard anyone else, trying whatever thing that's working for you. And it tends to be also when platforms start up. So like the early days of the Facebook newsfeed ecosystem, the early days of Google search, and whether that's on AdWords or organic search, there's often when these new forms of new platforms emerge, there's like a window where it's like, embarrassment of riches for those people who interact with that. So I think sort of always be looking out for that wave forming of a new platform or a new app store distribution. Again, 10 or 12 years ago, a lot of businesses were built on the back of that in the original times, and then more balanced sort of as they succeeded. But it's that kind of new system that if you've heard about people being successful in it, it's probably not new kind of thing.
Yeah, interesting. There was this idea that you talked about in a previous discussion where you talked about someone's life's work, and this idea of that's probably like a structural thing, because one of the things that I see in not just private markets but public markets is you see a lot of investing and a lot of people building things for the next iteration. So it might be what's happening in the next 2, 3, 4, 5 years, but oftentimes they come and they go. And the structural winners, i.e. generational companies, if you like, it usually has someone or something that's like complex, and yet it pervades the organization, and it's designed for something that's like an unmet need that's not just transient. Can you talk a little bit about, I guess, that finding that in people?
I think it's so useful both in the beginning and then for the company not to end. So in the beginning, that vision in someone's head of what they want to achieve eventually in the world keeps them going, in this kind of uncertain beginning where it's not clear that it's working right away. And then if it does work really well, someone is doing their life's work will actually say no to getting acquired at quite generous at the time valuations or dollar amounts, but it's the company's progress is so incomplete that they know that the end of the rainbow is 100 times bigger than that whatever very generous acquisition offer. So to get a $100 billion company, you need actually someone to say no to a $100 million acquisition and a $1 billion acquisition, because once a company is clearly successful, they will get acquisition offers, and really the person doing their life's work will say no to those very easily. Like I think the famous example is Facebook saying no to Yahoo for $1 billion quite early in their life, and people thought that was so crazy at the time, and now it's so clear that $1 billion was a dramatic undervaluing of Facebook, and so that life's work I think also produces these products and these services that take responsibility for something happening fully. It's not kind of I did my part and that's it. It's almost like this kind of relentless responsibility to say unless the world works this way, then I'm not complete. The other thing is, I think the joy is actually in its infinity. That the fact that mission is never achieved is actually the joy in the vision, where you could work for decades and still not be quite complete. Increase the GDP of the internet, which is Stripe's vision. It's so wonderful in its unattainableness, and so I think also when you have that kind of vision, the product roadmap expands. Oftentimes, someone builds a product, great, and then it just becomes about spending more on sales and marketing versus, I think, someone doing their life's work or a generational company, they build the first product, but that first product gives them ideas for the next 5 products, and the roadmap expands. And look at how Amazon took selling stuff on the internet to the Prime subscription and beyond. It's just that ever expanding product roadmap that would can last for decades versus, I think, companies where it's kind of like they launch one product and they kind of run out of ideas.
So, Niki, there's a lot of quote unquote value investors who listen to the show, and a lot of them would think, if you say that like to infinity and beyond, basically in terms of like the mission's never done, some of them may think, well, when do you get your value? Basically, how do you take that back? There has to be an exit and there has to be this and that. How do you, and this is more so a question generally speaking, so I kind of want it to be open-ended, which is, how do you think about valuing, if at all, these opportunities? I've heard you talk about valuation as an art form, but how do you think about that being so early?
Well, I would challenge, first of all, I would say venture capital and value investing have a lot more in common than you think, or at least the Warren Buffett version of value investing, which if you sort of divide up his career into 3 parts, one was the classic value investing, which was like buy $1 for 50 cents. Like, it's just so cheap that once the dollar is valued at $1, you make double your money kind of, and okay, if that's the brand of value investing, that is absolutely completely separate from venture. But the second phase of his career, and where he had the most success, was in this American Express, Coca-Cola, Geico, and it was really being a connoisseur of the highest quality businesses in the world. And I'd argue that venture capital is exactly the same. It's all about the creation of the highest quality companies in the world. The end result is Google and Microsoft and Apple, and those are venture-backed companies. And I would, Apple is Berkshire Hathaway's biggest investment at the current time. And Warren is best friends with Bill Gates, and his greatest investment regret is not investing in Microsoft. So I'd argue that the two worlds are similar in that version of value investing of the highest quality companies. And then the third phase of Berkshire Hathaway, because they have been so successful, they need to invest a lot of money, and so they need to do utilities and railways and so on. That's again separate from venture capital, but the second phase is very, very similar. The other, I would say, just having a long-term horizon isn't specific to venture capital, and I'd say one of the weaknesses of value investors is this constant mean reversion. They're like, hey, this is a certain company at a certain price point in the price cycle, and if it goes back to normal, I'm going to sell, and they're constantly having to look for new ideas because they're constantly back at square one, and that actually leads to a lot of error. I would say that sort of like it's just a lot of work for very little reward versus investing. Again, you have to appreciate the company. You have to invest at a reasonable price. But if you just bought and held Microsoft, or you just bought and held Apple, if you just bought and held Google and did nothing else, you would actually way outperform all of the little, mean reversion 100 times a year kind of busy work that a lot of value investors. So it's just like, if you're lazy, it's just a lot of work to do those short-term mean reversion. And I would say the ultimate return on your investment thinking is how to appreciate those generational companies, how to appreciate the highest of high quality, and then working out a way in which you can be a very long-term holder of those companies. Everyone's version of long-term is going to be different. In the venture capital world, we raise a fund, and that fund does need to be wrapped up in 10 years. So it's not an infinite time, and it is a set amount of time. But even 10 years is not, you look at the arc of these great companies, it's much more likely to be 30, 40, 50 years in length. And so everyone has their own timelines. Everyone has to consider the structures of their business and their own investing timelines. But I would say if you want to make the most money and you're actually lazy and you don't want to do the most work, find the best companies in the world and just hold them and don't overthink buying and selling of them.
Is that what gave rise to the follow-on fund?
Yeah, it was just very clear. Very clear that the venture capital industry was strangely structured. As I said, the seed fund invests in the seed round, and what that boiled down to in reality is that you invested in you invested in a company before you knew it was successful, and then as soon as you did know it was successful, you proudly said that you didn't invest anything after that, which doesn't make any sense at all. And then I would also say that that relationship that you built with the company affords you the opportunity to continue investing in the company. And so you had this combination of makes no sense to invest before you know it's successful and nothing after, and you've got the front row seat. You're the person that as that company succeeds, you have the chance to invest further capital. And so we, beginning from our second fund, we raise. So when we raise a fund in inverted commas, it's actually a number of different vehicles. It's essentially the seed funds, which is all the brand new companies, all the fresh new rounds. We invest in about 12 companies in Australia a year, and we invest in about 7 companies in New Zealand a year. And those seed funds make those first investments in the companies. We also raise a large pool of follow-on capital called the follow-on fund. And that is for all the existing portfolio and all those companies that are showing the most promise, that it's beginning to seem clear that a company is being successful, it will be successful. And so from 2015, that decision to keep investing in a company, I would say, is probably 10 times the size of Blackbird. So if we did everything exactly the same, we'd be 1/10 the size that we are because of that decision to keep investing in a company or not. Yeah, I was chatting to an angel investor not too long ago, and he was saying that when you think that when you have conviction in your investments, you want to find a way to have the maximum amount of leverage to your expertise. And so if your expertise is finding great companies, doubling down on them when you know that they are working, that is the thing that you should be looking to leverage again and again and again. And it seems you've done that by having that structure and being able to push that, because I see that all the time. I see people like, yeah, we're a small cap fund, we're a mid cap fund, we're a large cap fund. And you just think, why don't you just hold the thing? If that's the best idea, and if only in public markets, if only 1, 2, 3, 4% of companies that create all the value, why not just keep holding them? It sounds so simple, but that's just I guess a result of the structure and the way we set up finance in so many ways. It just seems backwards. Absolutely, yes. I think the portfolio allocation model, or in the way in which nearly every single institutional investor in the world structures their portfolio. That's the reason why there's the venture capital bucket, or the private equity bucket, or the small cap bucket, or the big cap bucket, or the Australian equity, the US equity. It's driven by that almost universal approach of institutional investors to have that portfolio allocation model. But it doesn't make any sense from an investment point of view of again the person with the most context on that company, the person who has seen the elephant picture, is sort of forced to step back when they know it's the elephant, and then the next person, they're not clear if it's an elephant, and the next person, and so on and so on. Yeah, for sure. Mate, I've got one more question for you, but I might just ask you for a moment. Now, you've driven in here from the city, into the city, and you've had this wonderful chat with us. If people are listening to this, if they're investors that want to get involved, if they're founders that want to get involved, and when I say founders, I mean past or present, where can they go? Like where would you direct them to? Yeah, check out the website. A couple of initiatives that were spoken about today were Startmate, so to be involved in the programs either as a startup or a mentor. Blackbird, we run a number of different programs there as well in terms of Giants, which is an online community, people who are just sort of thinking through an idea and they want to get feedback from other founders and other people within the industry. It's completely free and is a great program that thousands of people go through every single year. If you want a job at a startup, and oftentimes a precursor to founding a company is knowing the lay of the land or knowing how these companies do get created themselves. We have a program called the Lily Pad that sort of lets you meet a number of the portfolio companies of Blackbird and elsewhere. And if you're looking to sort of transition your career from perhaps a more generalist kind of background into a startup role, that program, Startmate, has a fellowship program that's similar aim. And so check out Startmate, check out Blackbird, and or contact me on Twitter, Niki Scevak, or email is pretty easy to work out, Niki@blackbird.vc.
Yeah, great. Watch out now. You might have to have a few filters on that.
Surprisingly, people do not do not take the opportunity. Yes.
Yeah, right. That's so surprising.
Yep.
Well, there you go. If you want to get in touch with Niki, and I'll put all the links in the show notes to that too, if it's more convenient. But the final question that I wanted to ask is, what's one thing that you believe about investing that few people would agree with you on?
Well, we have talked about the way in which the institutional investor world structures their portfolios into these particular buckets. I think the world comes down to these generational companies, and you want to have exposure to them across all the different sort of stages of their progress and all the different equity, debt, and so on. But I would say, to me, a much better way of thinking about the world is actually from that company attribute sense rather than the bucket sense.
Great. Well, Niki, thank you for driving in here, and thanks for taking the time to join me on the show.
Thank you for having me.